Welcome to our today's class of Advanced Public Finance and Taxation. We are going to proceed with our discussion of partnership. The second part of the partnership, which is the admission of a partner in the course of the year. Remember, we have already discussed the conversion of a partnership into a limited company. So today we are extending our discussion of the partnership by looking at the admission of a partner in the course of the year. We are going to do that by looking at a question. And the question we are going to look at is the question of June 2013. We will read through the question, and the question reads as follows. Malaika and Olai are trading as partners under the name of Molai Enterprises, sharing profits and losses in the ratios of 3:2 respectively. The following is the partnership income statement for the year ending 31st December 2012. Gross profit, 980,000. Dividends from Kola Cooperative Society, net. Rent income, 148,000. Betting and gambling income, 95,000. Capital contribution by Moki, 150,000. Total is 1,407,000, less expenses. Interest on capital, Maraika, 40,000. Olai, 60,000. Impairment of intangible assets, 9,600. Bad debts, 48,000. Professional fees, 36,000. Purchase of saloon car, 450,000. General expenses, 24,000. Partner's salary, Olai, 120,000. Loss on sale of investment, 38,000. Repairs and renewals, 15,000. Salaries and wages, 64,000. Dissolution of partnership costs, 72,000. Drawings by Malaika, 43,800. Provision for loss of profits, 19,200. Computer software costs, 28,000. Total expenses, 1,067,600. Net profit, 339,400. Additional information. 1. Moki was admitted as a partner on 1st October 2012 and was entitled to an interest on capital of 10%. 2. On the admission of Moki, the profit and loss sharing ratio changed to 3:1 for Maraika, Orai, and Moki respectively. 3. Analysis of bad debts is as follows. Bad debts, balance brought down, that's on the right-hand side, which is the credit side. We are specific, 60,000. General, 50,000. On the debit side, that is the left-hand side, we have bad debts written off, 36,000. Balance carried down, specific, 50,000. General, 72,000. Number 4, professional fees comprised. Audit fees, 18,000. Tax consultancy fees, 5,800. Preparing partnership deed, 8,400. Negotiating patent rights, 3,800. Total, 36,000. 5. Repairs and renewals included. Office partitions for shillings 6,400 and office carpets for shillings 8,000. Required a statement of the adjusted profit or loss of the partnership. 2. A schedule showing the allocation of the partnership profit or loss and the total taxable income of each partner. So basically, that is the information provided in that question, and the question is specifically dealing with the admission of a partner. As I have said, is the second concept that we are discussing under the partnership accounts. So here, I will go through the additional information explaining the effects of that note. So like note number 1, which says that Moki was admitted as a partner on 1st October and was entitled to an interest on capital of 10%. So it therefore means that we need to apportion our adjusted taxable income for purposes of allocation. So we shall first of all apportion to the two partners who were there for the first 10 months, for the first 9 months, that is from January to September, because Moki was admitted on 1st October. So the first two partners, Maraika and Olai, will share the profits made for the first 9 months. Then we shall have the sharing of profits for the other 3 months by the 3 partners, that is including Moki, who is admitted. So in our allocation schedule, we shall have it into 2 parts. 1 part for the 9 months, and the other parts for the 3 months, that is after the admission. Then number 2, we are told on the admission of Moki, the profit and loss sharing is changed to 3 into 1 for Moki and Olai. That again we shall effect, or we shall implement the changes in the ratios in the allocation of, in the schedule of the allocation for the purpose of the profit sharing. Then on number 3, we have the analysis of bad debts. Analysis of bad debts, we are given the bad debts account there. Now what we need to isolate from this account is the amount of bad debts which is not allowable. Now, bad debts written off are generally allowable, so there we don't need to do any adjustment for the 36,000. We then have the brought down figures. We have the specific brought down. We compare it with the specific, which is carried down. We see what has happened. We have 60 brought down. We have 50 carried down. It means there is a decrease in the specific profession. This decrease in the specific profession is taxable, and therefore we don't need to adjust for it. The general profession, we have the brought down figure of 50,000. And then the carried down figure of 72,000. What do we see there? We see an increase in the general profession of 22,000, which is 72,000 minus 50. Now, the increase in general profession is not allowable for tax purposes, and therefore we shall adjust by adding back the increase in the general profession. So from that bad debts account, the only item of concern is the movement of the general profession for bad debts. And here we realize it's an increase of 22,000, which we are going to add back when adjusting our net profit for tax purposes. Then, note 4. We are given the professional fees, details there. We are told it contains the audit fees of 18,000. The audit fees is allowable. Business expense, so that is allowable. The tax consultancy fees, that is allowable. Preparing the partnership deed, that is not allowable. So that we shall add back when adjusting or when computing the taxable profit. Negotiating patent rights, that is also treated as capital expenditure and therefore not allowable, and we shall also add it back when computing our taxable profit. Therefore, that is how we shall treat Note 4 of the professional fees. Note 5, repairs and renewals included office partitions and carpets. The purchase of office partitions is capital expenditure, and the office partitions qualify for capital allowances in Class 4. We give them wear and tear allowances in Class 4 at the rate of 12.5%. The same with the carpets. They qualify for wear and tear allowances in Class 4 at the rate of 12.5%. So our figure for renewals will be adjusted by deducting the two figures of 6,400 and the 8,000 there, which is purely capital expenditure. And then we shall give capital allowances, that's the wear and tear, for the same two items in Class 4 at the rate of 12.5%. Then, after going through the additional information, then again, as I've said before, it's good to look at the account itself, look at the other items of expenditure that may have not been mentioned in the additional information. So in this case, I will go through the items, mentioning whether the items are allowable or not allowable for tax purposes. So we have interest on capital. To Maraika, we have 40,000. To Olai, we have 60,000. Now, interest on capital is not allowable. Interest on capital and partners is not allowable, so that we shall add back. Impairment of intangible assets, that is not allowable. Impairment is the same as loss of intangible assets. So this loss of intangible assets is capital loss and therefore not allowable, so to be added back. Bad debts, we have looked at it in note number 3. So we don't need to look at it anymore. Professional fees, we have looked at it also in note number 4. So the explanation is already given in note number 4. The purchase of saloon car, that is also capital expenditure. A saloon car is an asset, a fixed asset, and therefore the cost is not allowable. Instead, we give the wear and tear allowance on the purchase of the saloon car in class 3 at the rate of 25%. We have general expenses. General expenses are generally allowable, so that we shall allow. Partner's salary are generally not allowable. So the partner's salary to allow 120,000, that will be added back. Then we have loss on sale of investment. That is not allowable. It is also capital loss. Just the way you have said that the impairment on intangible assets is also capital, the same is loss on sale of investment is also a capital loss and therefore not allowable. Remember, it is not arising from the normal operations of the business. Then we have repairs and renewals that was mentioned in note 5. Salaries and wages. Salaries and wages are allowable. Dissolution of partnership costs, that is not allowable. Just the way we don't allow the formation cost of a partnership, so we shall not allow the dissolution cost of a partnership. Drawings by Maraika, this is not also allowable. Drawings are not allowable, so we shall also add back the drawings. Profession for loss of profits, this is also not allowable, and therefore to be added back. Professions are estimates, and estimates are not allowed for tax purposes. So the profession for depreciation, for profession for loss of profits, the general professions for bad debts, all those are generally not allowable. Then we have the computer software costs. This is also capital expenditure, and we don't allow that, so it will be added back. In its place, we shall give wear and tear allowance at a rate of 20% straight line on the computer software. So basically, that's how we shall treat these expenses in the account. Then we have the income. So it's also good to examine the income to see whether there are incomes that are not for the business or incomes that are not taxable. So the first item of income is our normal revenue, which is the gross profit that is from the operation, therefore taxable. We have the dividends from core cooperative society, which is net. So the normal treatment of dividends from a cooperative society is that the dividends are supposed to be taxed when gross. So we shall gross up these dividends from the cooperative society by multiplying by 100/85 and tax the gross amount. So these ones are non-qualifying dividends, and that's why we shall subject them to taxation on the gross amount. Then we have the rent income. The rent income is taxable. The other item is the betting and gambling income. Betting and gambling income. Now, the rules for taxing betting and gambling income is that it is taxed at source, at withholding tax rates. So it is taxed at source at a withholding tax rate, and that withholding tax is final tax. So once it is taxed at source, that becomes a final tax. So the betting and gambling income is not taxed a second time on the recipient. Then we have capital contribution by Maoki. That is not a revenue income, and therefore it is also not taxable. So basically then we shall adjust for those incomes that are not from the operations, that is they are not business income, by deducting them from our net profit when computing the taxable income. But those that are taxable, we shall add them back in our allocation schedule, meaning the dividend income will be added in our allocation schedule. The rent income will be also added in our allocation schedule. So basically, that will be the treatment of the various items included in the account when computing the adjusted taxable income on that question. So we will begin by doing a few workings related to our notes, and then we go straight into writing the statement of the adjusted taxable income. So the question is June 2013, question number 3. And the question requires to do a statement. So the partners are Maraika and Olai. In fact, there are 3, should include the other partner. Malaika, Olai, and Moki. 2012 taxable income computation. So the procedure of doing this question is to first determine the adjusted taxable income for the 12 months period. Once we determine that taxable income for the 12 months period, then we shall apportion it for 9 months and then for 3 months and use that in the allocation schedule. So in this question, you don't redraft the account, but you start from the reported net profit. So we don't begin from the gross profit, but we begin from the net profit and then we adjust. But before we do that, we can do a few workings that are necessary in this question. So note number 1 is talking about, so note number 1, so we can call it our working number 1. We have the interest on capital of Moki, who is being admitted. So interest on capital of Moki. So he's entitled to 10% of his capital contribution. He ejected, or he contributed 150,000. So this 150,000, 10% is per annum, and since he's going to be there from the month of October, November, December, so 3 months, 3 divided by 12, we will be able to get the amount of interest on capital which he is entitled to. So 10% times 150,000 times 3, we divide by 12, we will get 3,750. So that is the interest which he is entitled to, the interest on capital. Then, on note number 2, we don't need to do the workings. We shall use that one in the allocation schedule. On note number 3, number 2 on note 3, we have the analysis of bad debts. Now, from these bad debts, what we need to just pick is the movement in the general profession. So I'll call it increase in general profession. This increase is brought down. We have the figure of brought down amount of 50,000, and it is increasing to a carried down figure of 72,000. So it is balance carried down is 72,000. This one we are subtracting the amount brought down of 50,000, and there we have an increase of 22,000. We have an increase of 22,000. Then the figure for professional fees. The figure for professional fees comprises a few items. In this case, we have the audit fee, the tax consultancy, the preparing partnership deed, and negotiating patent rights. There, we don't need any workings. We don't need any workings. On note number 4, we have repairs and renewals, which included the office partitions. Here, we may work the capital allowances. Capital allowances. Capital allowances. So which items qualify for capital allowances? In note 5, we have the office carpets. Office carpets. The office carpets cost 6,400. We are giving them wear and tear at the rate of 12.5%. So here, 0.125 times 6,400, we have 800. So that is for the office carpets. Then we have the one for, no, that's not office carpet, that's partitions, sorry. So this is partitions. Then we have the carpets. The carpets cost 8,000. So using the same rate of 12.5%, we have 8,000 times 0.125. We have 1,000. We have 1,000, that is the wear and tear for the carpet. Then in the question, they are talking of purchase of a salon car. So we shall bring the saloon car. The saloon car enjoys the wear and tear allowance in class 3 at the rate of 25%. What is the cost of a saloon car? Is 450,000. We are multiplying that by 25%. So we have 450,000. We are multiplying by 25%, and we are having 1,125,500 as the wear and tear for the saloon car. Then the other item that qualifies for the wear and tear is the computer software. We have the computer software. So software, computer software. The computer software cost 28,000. So this is 28,000. We are multiplying it by 20%. It is flat rate, a straight line, 20%, equal amounts every year. So 0.2 times 28,000. We have 5,600. Saluni car. Oh, nimeweka 45 eh? Oh, ni inafaa kuwa 450 eh? Tutaadjust tu. Hapa ni 45. Ni vile nimeweka 45. Ilifaa kuwa 450. So inafaa kuwa 112. Hivyo iko ni collect. Hiyo iko ni collect eh? So itaenda kituchanganya kidogo kidogo. Itaenda kituchanganya kidogo kidogo. But you'll see. Okay, continue. Yeah. Because niliweka 45. I don't know. Hata hapa unaona nimeweka ngapi? Even here I'm tempting to put 45. It is 450, yeah? 450 times 25%. Because the figure is 450. Hata sijui niandika 45 aje. Okay. Okay. We will take the total of our capital allowances. In this case, we have 800 plus 1,000 plus 112,500, 112,500 plus 5,600 to give us 119,900. That will be our figure for total capital allowances. Our figure for total capital allowances. So that finishes our workings from the additional information. From our additional information, then the other items that we can break is the interest on capital. So working number 4, interest on capital allocation. So this, we have the interest for 9 months, and then we can have interest for the other 3 months. So 9 months, then we have 3 months. So Maraika, the total for Maraika is 40. So this 40 is going to be apportioned for 9 months and then for 3 months. For Orai, we do the same for 9 months and then for 3 months. So we have 40,000 multiplied by 9, you divide by 12. Then we shall have, for 9 months, it will be 30,000. Then it means since the total is 40, we shall have 10,000 there, since the total was 40. So it is the 40 that we are apportioning. So 9 months, 30, 3 months, we have 10. Then we have 60,000 for Olai. So Olai, 60,000. So the 60,000, we multiply by 9, we divide by 12. So we shall have 45 for 9 months, and then we shall have 15,000 for the other 3 months. 45,000 and 15,000 for the other 3 months. Since we are breaking that, since in the allocation schedule, we will take 9 months, then we will take 3 months. So we need to know how much interest will be paid for 9 months and how much interest will be paid for 3 months. So in this case, if we were to bring this other person called Morky, this other partner called Morky, Morky's total is 3750 from our working number 1, and all this would be allocated for the 3 months period since Morky joined from 1st October. So we are giving Morky for 3 months, October, November, and December. October, November, and December. The other working that I can add is the gross dividends. Gross dividends. Now, the dividends we are given here are from a cooperative society, and we are told they are net. Normally, for tax purposes, the dividends are non-qualifying. The dividends from the cooperative society are non-qualifying, and we tax the gross amount. Now, how do we get the gross amount? The gross amount is obtained by multiplying the net dividends by 100 over 85. The reason being, the net dividends are 85% after 15% withholding tax. So already a 15% withholding tax has been deducted. So the amount which is net is 85%. So in this case, we can simply say that 85% is this figure of 34,000. So what is 100%? Would be the question. 100% is what? So in this case, our 100% will be given as follows. So the gross dividends, we put it as gross dividend equals 100 over 85 multiplied by our 34,000. And in this case, we have 100 divided by 85 times 34,000. It will give us 40,000. So our gross dividends, therefore, will be 40,000 from our working number 5. So basically, after analyzing that information or synthesizing and breaking down that information, we can go straight into part 1 of the question, whereby we are required to compute, to now get the adjusted taxable profit or loss of the partnership. So we begin with our reported net profit. So we proceed into computation of the adjustable taxable profit or loss of the partnership. And here, as I said before, we don't redraft the account, but we start with the net profit as per the account. So net profit. Okay, so we start with the reported net profit. So the net profit is 339,400. Now this figure is therefore to be adjusted, normally by adding back the disallowable expenses. So add back disallowable expenses. So we start with the expenses mentioned in the notes. Note number 3, the increase in the general profession from our working number 2. So increase in general profession. This amount is 22,000 from our workings number 2. Workings 2. From note number 4, professional fees. Audit fees, we said, is allowable. The tax consultant's fees is allowable. Preparing partnership deed, not allowable. We added back. Partnership deed. So 8,400 is not allowable. Negotiating the patent rights is capital. So patent rights, an amount of 3,800, we added back. Note 5, repairs and renewals. The capital expenditure there, the office carpets. So carpets, partitions first. So partitions. The partitions is 6,400. Carpets, we add back 8,000. So that is from the additional information. Once we are through with the additional information, we examine the account itself. So item number 1, interest on capital. So interest on capital. The total figure for interest is 40,000. That is for Maraika and Olai 60,000. Therefore, this is 100. So 40 plus 60, giving us 100,000. All of it not allowable. Impairment of intangible assets, 9,600, not allowable. Impairment. That is 9,600, not allowable. We add back. Bad debts, we have looked at it in note number 3. Professional fees, we have looked at it in note number 4. Purchase of Saruni car, we added back. Saluni car is capital expenditure, 450,000, we added back. General expenses is allowable. Partners' salaries for Olai, not allowable. Partners' salary. In this case, Olai is got a salary of 120,000. So that we add back. Partners' salaries generally not around. Loss on sale of investment, this is capital loss, not allowable. Loss, sale of investment, that is not allowable, 38,000. Then we have repairs and renewals. That we have looked at in note 5, where we have added back the carpet and the partitions. The rest of the repairs and renewals is allowable. Salaries and wages, allowable, all of it. Dissolution of partnership, cost. So dissolution cost, we don't allow that, 72,000.